There's a moment in every market crash that almost nobody discusses, occurring precisely 48 hours before financial landscapes fracture. During this window, while traders toast record highs and investors brim with invincibility, a distinct pattern emerges beneath the celebratory surface. This pattern is not rooted in complex algorithms or secret economic formulas, but in the relentless repetition of human behavior across decades, nations, and every major financial disaster. The story of a crash does not begin with the plummeting numbers, but with the nearly invisible warnings that hum like a dissonant chord beneath the symphony. To understand these 48 hours is to understand the fundamental nature of financial markets as living systems, how they breathe in greed and exhale fear, how terror masquerades as confidence, and how the most catastrophic losses always telegraph their arrival to those who have learned the silent language of the charts. This pattern manifests through a convergence of technical signals, psychological shifts, and structural vulnerabilities, all escalating in a predictable sequence that has preceded collapses from the Great Depression to the digital age. Its greatest danger lies in its subtlety. These signals bloom during periods of maximum optimism, making them easy for the euphoric crowd to dismiss. The very conditions that birth the crash are the same ones that blind participants to its approach, creating the central paradox of market psychology. When peril is most acute, our capacity to perceive it is most impaired. The birth of false confidence, the peak before the plunge. The pattern invariably ignites with a surge of collective assurance. 2 days before disaster strikes, market sentiment achieves a fever pitch that feels unshakable. Cautious investors shed their reservations, skeptics are mocked into silence, and trading floors vibrate with the energy of apparent inevitability. This is not random emotion, but a measurable psychological phenomenon visible in every historical bubble. Before the 1929 crash, economists declared a permanently high plateau. In early 2000, analysts insisted traditional valuation metrics were obsolete for the new economy. In 2007, reports proclaimed the housing market had stabilized. This peak creates an illusion of control where participants believe they understand the market's mechanics perfectly, when in reality they are simply surfing a wave of collective euphoria. The narrative in media and conversation shifts from prudent investment to frantic acquisition, fueled by social proof and the agonizing fear of missing out, FOMO. Yet beneath this veneer of triumph, systemic vulnerability crystallizes. As more capital floods in at peak prices, often leveraged through debt, it constructs a financial edifice so fragile it cannot withstand the slightest tremor. This extreme confidence, therefore, is not an indicator of health, but the final, most deceptive stage of a speculative mania, a warning that reality is poised for a violent return. The volume anomaly, the footprints of the smart money. As confidence peaks, volume begins to tell a hidden story. While the average investor watches only price, sophisticated participants watch volume, the intensity behind the move. In the critical 48 hours, volume often spikes in peculiar, inconsistent patterns. These anomalies reveal a clandestine exodus. Institutional investors and seasoned professionals begin methodically exiting positions, while retail investors, electrified by recent gains, pour in. This creates distribution volume, high activity where smart money is quietly selling to enthusiastic latecomers. Before Black Monday in 1987, unprecedented volume surges revealed pension funds liquidating as individuals bought. Before Lehman's fall in 2008, frantic trading in financial stocks saw hedge funds offloading risk to retail buyers. The professionals execute these moves carefully, breaking sales into smaller blocks to avoid triggering panic, but their actions leave distinctive footprints in the data. Unusual spikes at specific prices, imbalances between buy and sell orders despite rising indices, and erratic bursts of activity. These footprints, visible only to those analyzing volume in context, consistently materialize exactly 2 days before the structure breaks. Volume analysis distinguishes between healthy advances and speculative froth. Sustainable rallies are supported by gradually expanding volume, indicating broad participation. The pre-crash anomaly shows intense but distorted activity, signaling distribution, not accumulation. It is a fundamental early warning system tragically ignored by the crowd hypnotized by ascending price lines. The media's dangerous feedback loop. During this window, media coverage adopts a specific, historically predictable tone. Financial networks feature experts competing to outbull one another. Magazines run cover stories on unending prosperity. Social media feeds overflow with tales of effortless wealth. The language itself becomes absolute, saturated with terms like guaranteed, revolutionary, and never before. This rhetoric is not trivial. It shapes perception, and perception drives market behavior. This dynamic creates a powerful feedback loop. Optimistic coverage boosts sentiment, which justifies more optimistic coverage, which inflates sentiment further. Academic sentiment analysis of news articles before the 2000 and 2008 crashes shows positivity and certainty scores peaking precisely in this 48-hour window. The media is not necessarily peddling falsehoods. Journalists typically report the prevailing mood, quoting the most prominent and often most bullish voices, but in doing so, they amplify that mood into a dominant force, spotlighting gains while minimizing cracks in the foundation. This dynamic has evolved from newspaper headlines in 1929 to cable news in 2000 to algorithmic social media feeds today, but its core function remains unchanged: to sing a song of unwavering optimism until the very moment the music stops, reinforcing the crowd's conviction while the underpinnings rot away. The derivative warning, where the smart money bets. Beneath the surface of public equity markets lies the vast, complex world of derivatives, options, futures, swaps. Here, in this arena dominated by institutions, the 48-hour pattern reveals itself through sophisticated pricing anomalies. The most telling is volatility suppression. Implied volatility, which should rise as markets become extended, often remains strangely muted or even drops. This occurs because large players are actively selling volatility through complex strategies to maintain a facade of calm while they exit positions. It's the financial equivalent of calmly backing away from a lit fuse while assuring everyone it's a fireworks show. Derivatives markets offer this warning because they allow nuanced bets on future probabilities. When insiders sense risk, they might buy protective puts or hedge exposures, activities that distort derivatives pricing in ways that contradict the bullish equity narrative. Before the 2010 flash crash, unusual activity in deep out-of-the-money puts signaled hidden fear. Before the COVID collapse in February 2020, put options on travel and financial stocks saw bizarre volume spikes. These signals are technical and opaque to the public, which is precisely why they remain reliable. They haven't been arbitraged away by the emotional crowd. Derivatives are forward-looking. They price expectations about volatility and tail risk. When they whisper a different story than equities shout, it signals that those with the best tools and information are preparing for a different, darker future.
The liquidity illusion, skating on thin ice. 48 hours out, a critical but invisible shift occurs. Liquidity begins to evaporate. Liquidity, the ability to trade size without moving the price, is the market's shock absorber. When it is abundant, markets feel stable. When it vanishes, they become brittle. During this window, bid-ask spreads subtly widen, market depth, orders waiting at prices, shallows, and the number of willing buyers at current prices dwindles. This creates a dangerous illusion where prices can still float higher on light volume, appearing healthy while their foundation turns to sand. Professionals call this skating on thin ice. The mechanism is rational. Market makers and institutional liquidity providers pull back their bids and offer less size when they sense rising risk, protecting their capital. This removal of shock absorbers, however, creates systemic fragility. Meanwhile, retail and algorithmic trend followers often increase activity, their smaller trades masking the underlying deterioration. The illusion holds until a trigger prompts a rush for exits, at which point sell orders meet empty order books and prices gap down violently. This was evident before the 1997 Asian crisis, the 2008 debt crisis, and the 2021 meme stock reversals. The liquidity illusion is self-reinforcing. As some sense thinning liquidity, they grow more cautious, further reducing liquidity. By the time the average investor notices, the market structure is already a house of cards. The retail investor surge, the buyers of last resort. The most tragic element of the pattern is the fate of the everyday investor. During these final hours, individuals who have waited on the sidelines, often for months, succumb to overwhelming psychological pressure. They see relentless gains, hear success stories, and are gripped by the fear that prosperity will pass them by. Data from brokerages consistently shows spikes in new account openings, first-time deposits, and retail trading activity immediately before major declines. These investors become the buyers of last resort, providing the final fuel that pushes prices to their absolute peak and, crucially, providing the liquidity that allows smart money to exit. They act on stale information, buying the culmination of a move rather than its inception. Behavioral drivers, FOMO, recency bias, and social proof converge into an irresistible impulse. The democratization of trading via commission-free apps and social media amplifies this effect, blurring lines between investing and crowd following.
Professionals watch for this surge explicitly. It is their signal that the top is in. The aftermath is cruelly predictable. These late entrants, often leveraged and concentrated in the most extended assets, suffered disproportionate losses, frequently compounding the error by selling at the bottom. This surge represents the euphoric final stage of the psychological cycle, where emotion obliterates reason and sets the stage for the inevitable reckoning. The credit market whisper, a smarter reality check. While equities celebrate, credit markets often tell a sobering counter-narrative. Credit markets, corporate bonds, credit default swaps, are dominated by institutional investors who focus on cash flows, default probabilities, and balance sheets. They are considered smarter and less emotional than equity markets. In the pre-crash window, a telling divergence often emerges. Credit spreads, the extra yield demanded for riskier debt, begin to widen, and bond yields behave cautiously, even as stock indices hit new highs. This is the credit market whispering its doubts. Before 2008, credit default swaps on mortgage securities and bank debt widened dramatically months before stocks collapsed. Before the dot-com crash, junk bond spreads for tech companies widened ominously. This divergence creates a non-confirmation, a failure of one crucial market segment to validate the strength of another. In healthy times, credit and equities move in harmony. When they split, it suggests equities are ignoring fundamental rot. Credit markets, less prone to manic sentiment, serve as a crucial reality check. The disconnect cannot last. History shows equities usually capitulate to credit's grim assessment through a violent downward adjustment. The failed rally pattern, the market's last gasp. On the final day, the market often stages a characteristic failed rally. Prices may open strong, even setting new intraday records, but the advance lacks conviction. Gains erode through the afternoon, trading turns choppy, and the smooth upward momentum of prior days fractures. This is the market's last attempt to climb before exhaustion wins. The failure occurs because the buyer-seller balance has secretly shifted. Hopeful buyers remain, but they are now matched or outnumbered by strategic sellers distributing their holdings. Volume during this failed rally can be high, which paradoxically confuses observers into seeing healthy demand, but detailed analysis reveals the volume is overwhelmingly sell-side. This pattern was visible on the Thursday and Friday before Black Monday, in the sessions preceding the 2010 flash crash, and before the COVID collapse. It represents the final failed test of the highs before gravity assumes control. The failed rally is the technical manifestation of the psychological point of no return, the last wheeze of a tired bull. The overnight risk, while America sleeps. A critical vulnerability in the modern 24-hour global system unfolds while the largest market, often the US, is closed. During the night of the 48-hour window, Asian and European trading can show mounting stress, weakness in foreign indices, unusual currency moves, rising fear gauges. American investors awaken to see their portfolios still buoyant from the previous day's close, unaware that risk is metastasizing overseas. This overnight risk transmission was clear before the 1997 Asian crisis, the 2011 Japan tsunami sell-off, and the COVID crash, where futures markets plummeted in overnight sessions. The global financial system is a networked web. Trouble anywhere eventually spreads everywhere. The closure of a major market creates a dangerous vacuum where panic can build unchecked, meaning the crash often begins in darkness, arriving fully formed by the opening bell.
The correlation breakdown. Everything moves together. In normal conditions, different assets, tech stocks, utilities, bonds, commodities, move with distinct, diversified relationships. During the final hours before a crash, these correlations break down. Everything begins moving in unison, driven not by individual fundamentals, but by a single factor, systemic fear and the urgent need for liquidity. This breakdown signals that the market is no longer functioning as a discriminating mechanism, but as a panic-stricken monolith. Before 2008, disparate asset classes locked into synchronized declines. Before the COVID crash, even traditional safe havens initially fell with speculative assets. This correlation meltdown indicates a regime shift from normal trading to crisis mode, where the only thing that matters is raising cash. It is a clear, quantitative sign that the entire financial ecosystem is under stress, even if the reason isn't yet on the front page. The insider signal and the margin debt peak. two concrete data points flash red. First, corporate insiders, executives, and directors legally report their trades. In the weeks and days leading to a crash, insider selling often accelerates while buying dries up. These individuals have the clearest view of their company's real health. Their collective retreat is a powerful signal, as seen before the 2000 tech crash and the 2008 financial crisis. Second, margin debt, money borrowed to buy stocks, reaches an extreme peak. Confidence begets borrowing, which pushes prices higher, which begets more borrowing. This leverage creates fatal fragility. When prices fall, it triggers margin calls, forcing sales that trigger more margin calls, a devastating downward spiral. Record margin debt preceded 1929, 2000, 2008, and 2021. It represents maximum financial strain at the moment of maximum psychological confidence. The divergence. Price detaches from value. At the core of every crash is the ultimate divergence, price versus fundamental value. Metrics like price-to-earnings ratios, price-to-sales, and total market cap to GDP reach unsustainable extremes. This gap widens over months, but achieves its final ridiculous altitude in the last 48 hours. Value investors have typically already left, replaced by momentum traders buying simply because prices are rising. The market becomes a pure sentiment engine, disconnected from economic reality. This divergence cannot persist. Eventually, earnings reports, economic data, or an external shock forces a brutal reconnection. The wider the gap, the more violent the closure. The psychological point of no return. All these signals culminate in a collective psychological threshold. The market becomes what physicists term a critical system, an avalanche poised for a single snowflake. At this point, bears have capitulated, skeptics are silent, and caution seems foolish. This unanimity exhausts the pool of potential buyers. Everyone who could be bullish already is. The market has reached maximum occupancy on one side of the boat. Stability itself becomes the illusion, as the system is now hypersensitive to the smallest trigger. This point is identifiable in hindsight through sentiment surveys, put-call ratios, and the utter absence of contrary voices. It is the calm containing the entire energy of the coming storm. The crash begins. The pattern completes. When the 48 hours expire, something, a poor earnings report, a failed auction, a geopolitical event, provides the trigger. It is rarely the true cause, merely the spark for the accumulated tinder. The crash unfolds in waves. First a healthy correction, then breaking support levels, then margin calls and algorithmic reversals feeding the fire. The media tone flips from celebration to confusion to blame. Participants are stunned by the speed of change. But the crash was not caused by the trigger. It was caused by the completed pattern, the extreme confidence, the hidden selling, the liquidity drain, the leveraged excess, all perfectly aligned during those 2 silent days. The eternal pattern. The 48-hour pattern reveals an eternal truth about finance. It is a human system, and human nature is cyclical. We are pattern-repeating creatures, and our markets are mirrors of our psychology. The details change, the technology, the asset class, the jargon, but the underlying sequence of blind confidence, smart flight, and catastrophic correction remains. The lesson is simple, yet nearly impossible to apply. Extreme consensus is dangerous. When everyone feels safe, you should be most alert. The time to worry is when worry disappears. This pattern will repeat because it is not a flaw, but a feature. Those who learn to see the subtle tremors in those final 48 hours gain not a crystal ball, but something more valuable, the awareness that storms form brightest skies, and that the most important signals are often the quietest ones, whispering exactly 2 days before the world changes.